Futures contracts can seem complicated, but they are simpler than you might think. In essence, a futures contract is an agreement. It's an agreement to buy or sell a specific asset at a future date. This asset could be anything from corn to gold or even company shares. The price you agree on today is called the futures price. This price is determined by the market's expectation of what the asset's value will be on the set future date. Think of it like pre-ordering a new phone that's launching next month. You agree on the price today, but you get the phone later. That's a futures contract in a nutshell. Futures contracts are used by businesses to manage risk. For example, a farmer can use futures to lock in a price for their crops before harvest. This protects them from price drops. On the other hand, a baker can use futures to secure the price of wheat for their bread. This protects them from price increases. Now let's delve into a specific type of futures contract: equity futures. Equity futures are simply futures contracts where the underlying asset is a stock or a stock index. Imagine you believe the price of a particular company's stock will rise in the next few months. You could buy an equity futures contract for that stock. If your prediction is correct and the stock price goes up, the value of your futures contract will also increase, and you can profit from it. Unlike buying individual stocks, which gives you ownership in a company, equity futures offer you a way to participate in the stock market's movements without actually owning the underlying shares. They are a leveraged instrument, meaning you can control a large number of shares with a relatively small amount of capital. However, this leverage also comes with increased risk. If your prediction about the stock price movement is wrong, you could lose more money than you initially invested. In the next section, we'll explore the mechanics of trading equity futures. Trading equity futures involves understanding several key concepts. Lot size. Each equity futures contract represents a specific number of underlying shares. This is called the lot size. For instance, a single futures contract for company XYZ might represent 100 shares of XYZ stock. Margin requirement. You don't have to pay the full value of the contract upfront. Instead, you need to deposit a percentage of the contract value with your broker. This is called the margin requirement. Margin trading allows you to control a large position with a smaller amount of capital, but it also amplifies your potential losses. Mark to market. Your equity futures positions are settled daily based on the current market price of the underlying asset. This is called mark to market. If the value of your futures contract increases, your account is credited. If it decreases, you'll need to deposit more funds to cover the loss. Expiry. Every futures contract has an expiry date. This is the date when the contract must be settled. You can either close your position before expiry by taking an opposite position in the same contract, or take delivery of the underlying asset. Trading equity futures offers several potential benefits. First, it provides leverage, allowing you to control larger positions with a smaller capital outlay. Second, it offers flexibility, allowing you to take both long and short positions, profiting from both rising and falling markets. Third, it provides hedging opportunities for investors looking to manage their portfolio risk. However, these benefits come with inherent risks. The leverage that makes futures attractive can also magnify your losses. The daily mark-to-market process can lead to substantial gains and losses, requiring you to constantly monitor your positions. Finally, the complexity of futures contracts requires a good understanding of the market and trading strategies. Before venturing into equity futures trading, it's crucial to thoroughly research, understand the risks involved, and if necessary, consult with a financial advisor.